October 10, flash crash in crypto, $19 billion gone. Does regulation have a role to play? With me is Morgan McCarthy, analyst at Kaiko Research on the JDB Report. Morgan McCarthy of Kaiko Research, welcome to the JDB Report.
Thanks for having me, James. Really happy to be here.
Appreciate your coming on to walk us through what happened on the weekend of October 10th when there was a big flash crash in the crypto markets, to maybe get a sense of why, what happened, and if this is just the nature of the beast or if things can change to improve the robustness of the trading infrastructure and the markets.
Yeah, for sure. I'm happy to kind of run through that. I think we spent a lot of the last 2 weeks dissecting the nature of this. And as you said at the offset there, part of this is the nature of the beast, but then part of it is the kind of immaturity and market structure of crypto markets as well. So I think if we go from the top on things, crypto was near its record highs around the end of September, and it was trading. Bitcoin was about around 120K. Prices were quite elevated in line with equities, but there was a lot of leverage building up in the crypto market at that point, and leverage in the form of perpetual futures, where this is a kind of crypto specific product where there's no expiration on the futures contract. This trades in perpetuity, hence the name. That was the case kind of, let's say, the weeks leading up to it. There was a lot of leverage. There was a lot of people taking kind of over their skis, you might say. And then it was a sort of perfect storm. Friday evening, heading into the weekend, US market is coming to a close. And there's, a tweet from US President Trump talking about retaliatory tariffs on China, because I think 24 hours before they just put some rare earth mineral tariffs on. So that even sent, other markets were kind of going down on that. The S&P was down, I think, 1.5% or so after hours. NASDAQ and everything else was trading lower, where they were less liquid. But obviously the problem then you have with crypto is that it's trading all the way through the night, all the way through the weekend. So while there might be an hour or two, 24/7, and it's a blessing and a curse, I think. And we used to see a lot of liquidity at the weekends, and there was more weekend trading. But, in our research, we've seen that's become less and less of a thing. So more and more of the trading is concentrated around US hours. So when you get this tweet right towards the end of the day on a Friday from the president and the market's spooked, prices start going down, there's less liquidity. And I think one of the things it highlighted was that there's not a lot of breadth right now in the crypto market. Bitcoin, Ethereum, Solana, XRP, these things have volume. Obviously the stable coins, USDT, USDC. Beyond that, there's really not much depth, And that was kind of highlighted when you saw these order books were cleared across the board. And then it looked like, there was more structural things that we can get into. But I think one of the key things for me is, when Bitcoin drops 5-10% because of this shock, those other assets, they're higher beta to Bitcoin and they're less liquid. So it's like, it's just a match to a tinderbox. It sparks the whole thing. Dogecoin's down 60%, even some sort of popular altcoins are down 40-50% in an hour, 2 hours. And
what's the price that people pay to use that as collateral? I mean, a lot of these deals are using these thinly traded, questionably robust coins as collateral. Are markets treating those as normal assets? Is the premium that you'd have to pay to use that as collateral high enough?
I think it's probably not high enough. And what you're seeing is with some assets on some exchanges, there's promotion. You might get a certain pair, you can use a collateral, you can use a certain asset as collateral on that platform, you can't other places. So there's also sort of singular market potential, like risks and failures in certain venues. And these venues are also sort of certain size that can cause broader issues. So if we're going to increase the kind of spectrum of assets that we accept for collateral, it's risky unless they're robust pricing and there's liquidity. So I think you saw that the price is cleared, and then it sort of, even Bitcoin's prices were whipsawing around. So even if you're using Bitcoin at that point as collateral, there's there's a risk there. But if you're using, a token that's outside the top 10 or 15 as collateral, or a stable coin that's not one of the top stable coins, one of the most liquid, with like, multiple venues, then you're going to potentially have risks of dislocations in price. But another issue that kind of came in with that collateral thing, around the whole collateral issue was, collateral was being priced majorly on one market on some venues. So, you have perps like, Kaiko, we do rates. We source the price across multiple venues. We have anomaly detection. We smooth for outliers. So you look at our rates over the crash, they're pretty tied to the true price, because, we're sourcing from everywhere. Most perps venues do that. Some of them have a heavy weighting towards their own spot market. So if you're Binance, Bybit, OKX, and you're pricing a perp product, some of them are using like, 60, 70, 80% of the price from their own spot venue, and then sourcing from other venues to sort of correct for outliers maybe. Really, it should be a more robust reference rate practice. But at least there is some kind of broad sourcing on these venues. But when it comes to collateral, it seems like a lot of them are just pulling from their own spot market. So if you've got a long tail asset and you're using that as collateral, and it's only pricing from one market and there's only limited pairs, so all it takes is a shock like this where the liquidity dries up, the price dislocate, and then if you have on a Friday evening, you've just got a sort of liquidation engine that's deciding how these things are closed out. It's the perfect kind of recipe for disaster. I think but it is still the nature of the beast, and it's a reminder that despite these Bitcoin ETFs, Ethereum, Solana, XRP, we've got basket products coming, the market's still very fragmented, and there's still pricing practices and there's still infrastructure practices that are just not fit for purpose as we get into it, proper capital markets, proper traditional finance space.
What has to happen to improve those things that are not fit for purpose, to make them so? I assume that this ultimately the sword hanging over the king's head in this case is the threat of regulation if it doesn't actually get done by the industry itself. But let's put that aside. Who are the players that have the capacity and the business incentives to make improvements?
Yeah, I think a lot of it has to be driven from within at the moment. There are players out there. There's, the global blockchain council like GBBC that are doing things around risk mitigation frameworks. Sandra Rowe there is doing great things. But also it comes back to, like regulation, I think, more broadly, unless we're going to do it. I don't think exchanges, I don't think perps venues, if you're launching a platform, you're seeing what's happening with Hyperliquid, you're seeing what happens with these DEXs where now there's zero fees. People are trying to attract new users. If you're going to bring in a pricing regulation and say, I'm going to go and outsource my pricing to be a more regulated reference rate provider like Kaiko, like whoever else in the market, that's going to bring in a cost. And if you're trying to capture the market there and gain users, well, Hyperliquid, like Lighter, one of these other DEXs, variational, someone is going to be charging less fees. And they might not be doing that. Some of them are. I think, we work with variational. We work with other teams, but not all of them are. So it's a cost that it's hard to justify if others aren't doing it and they're getting market share. So I think it comes back to regulation that we're seeing with MiCA, and sort of the infrastructure that is there in Europe with MiFID regulations and everything else already before it. There's a clear framework for how to do this. And we work with partners, One Trading, D2X, EDX in APAC and across. We have Gemini, but that's because they're regulated venues. They're venues that want to do this the right way, because they're in this not for the next 3 years, but for the next 10, 30 years. They see this as a long-term play. So but that's only a small section of the market right now. It's growing. More people want to be regulated and do this right, but it's going to take, I think, some regulation more broadly. So like, while the environment in the US has improved and the new administration is less, regulation by kind of force,
Right.
It's not there's not a lot of clarity on this. We've seen there's a new CFTC chair coming in, I believe. This might be where that comes into play, and there is some pricing because perps are launching there. We're working with Cboe and others. Coinbase have launched their own. They seem to be pricing. I don't know who they're pricing with, but there's no clear guidelines in the US on how to do it. We do it with Cboe because Cboe's one of the oldest derivative platforms around. So they want to do this the right way. Unless it's regulation to say you need to mitigate risk by having a proper pricing, proper dispersion of data and price levels, then we're going to have more of these issues in time, because perps are the most popular product in crypto. They're 60,
Right.
70% of the market. And if I can
And
trade
they're
them at
100x leverage, many of them, right? I mean, they've been marketed as 100 or even more leverage. So, I mean, leverage to me seems, on the one hand, you're always playing with fire with that, especially at that level. On the other hand, that's what people want. I mean, that is what's made the markets popular. So, uh, do you expect leverage to be part of that discussion, or do you think that will have to be left alone and other aspects of the system will have to ramp up somehow to mitigate the swings of that?
I think it has to be inevitably a part of the conversation, because you see, like with these products launching in the US, there's 10, 20x leverage maybe, because they're aware they're in the US, they're onshore, and they're just being a bit more careful. But when you look at 100, 120x, it's some places that you can get. So that makes that kind of sensitivity for liquidations even higher. So if that
Right.
price is deviating even more, then you've got more risk. So you need to be even tighter on that pricing and that accuracy. But the liquidation models are quite opaque at some of these firms, some of these dexes and other places. So, without the regulation to say, I think, eventually we'll get to a point where there's a cap on some of that in unregulated venues, because the higher up you get in leverage, the more accurate you need to be. And the nature of crypto right now, as you said at the offset, the nature of the beast is it's fragmented, it's volatile, and it's like a feature, not a bug for most of these traders. But
Right.
that
They love
doesn't
the
mean a broad.
volatility.
Yeah, they're here for it. But as this becomes a broader asset and it's an asset class in its own case, I think that has to be kind of eventually sort of hemmed in a little bit. Like, you can't have Bitcoin, ETH, Solana, all of these assets in people's 401ks or whatever's happening with, whatever you can do now in an ETF in the
Right.
US. And then someone is going to be able to trade 120x leverage on, way over their skis and cause a 20% sell off that, could eventually become a sort of systemic thing, broadly the market. So there has to be regulation, I think, for everyone, because while those traders might be able to chin it and like it's what they're here for, it's now a full market. There's there's other areas of the market that need to be considered. So I think it comes down to regulation. I think there will eventually be a cap on some of those liquidity. I don't think those leverage kind of multiples. I don't think we'll see 150x leverage on SIBO or CME or any of these venues for a reason.
Yeah. So the argument you're making, Adam, is that if we're to have more exposure or connectivity between TradFi and traditional lending and investment products with anything that's blockchain based, then the blockchain world is going to have to change more than the traditional world. Is
Yeah, I
that is
think.
that where, or can that go the other way as well?
Yeah, I mean, I think that it can be a marriage of things where some of that kind of speed and that efficiencies of crypto, in a sense, they can complement some of the practices that are there already in traditional finance, but it's never going to be complete takeover. I think 10 years ago when I first got interested in crypto, I thought this was an amazing thing. It was going to change the world. And I think then you get older and you kind of spend a little more time and you think if you can just change a couple of things in the world, it's actually pretty. That's how
That's
the
already a
kind of
win.
revolution starts. Yeah, that's how you win. You're not gonna, if you put that shoot for the moon, you're gonna end up disappointed. But if you kind of look at it and think, 3 years ago, even if we have Bitcoin ETFs and we have regulation and crypto czars in the White House, that's a huge win. I mean, for legitimizing the asset class. So I think, it's gonna have to cede some ground on certain things, and other areas, settlement, on-chain issuance for tokenization, things like that can speed up traditional systems. I know we have FedWire and FedNow is coming in, but if you can do some tokenization on chain, you might be able to get your kind of collateral capital back and be kind of quicker into new trades. Things like that are
Yes.
cool. They're interesting. People are trying it out. The Canton Network, Don Wilson's DRW is working massively on that. We're working on it. There's likes of DTTC, and there's others working on there, because those efficiencies make sense and they improve things.
Yeah.
150x leverage. I don't think you need to adopt that if you're on Wall Street. I don't think you're too keen on on taking a perpetual future on, Shiba Inu coin or whatever it is. I don't think those things will pass over straight away. Maybe I'm wrong.
Yeah. One thing from your research highlighted on the October 10 flash crash is that although we saw even Bitcoin as well as other coins had price discrepancies and mispricings across exchanges, uh, Tether traded at a premium in some cases. What does that tell us about the role of stablecoins and perhaps USDT in particular?
Yeah, it was a small premium, but notable in that I think, and what I noticed is that a lot of trading went into USDT pairs or even just USDT. So I think because it's that behemoth, it's so big, it's withstood a few of these crashes. 2022 Tether was pretty solid, maybe a few dislocations on secondary markets, but from all accounts, money has always been able to be minted and burned there, redeemed. If you have X amount of Tether over the 100K or whatever, the amount is you can go and get your 100K US dollars, whatever it is, back from them. So I think it's because of longevity, size, and just notoriety. It's done the job in the past. People will
Yeah.
fly to quality. So like you're seeing Bitcoin bounce back more, ETH bounce back pretty quickly or solidly over the weekend. But those other smaller assets didn't see as much, and other stable coins didn't see a premium, let's say, or a slight kind of premium on secondary markets because they're just not as large and not as able to kind of withstand things. Tether is multi-hundred billions stablecoin now. So if you've got a risk in the market and smaller stablecoins, smaller tokens are dislocating or missing their peg, then you're going to kind of just switch to that, switch to that behemoth, I guess.
Yeah. One of the issues is also raised, you mentioned fragmentation of liquidity. This is not unique to crypto markets. I mean, in equity markets, the whole algorithm trading industry has arisen to address, finding liquidity, cross-selling different pools or streams of liquidity, institutional versus retail, dark pools, lit pools, on exchange, whatever. There's there's a lot of variety there. And in the US, at least, you may have multiple, 15, I think, stock exchanges, but you've got one price essentially. And by regulation. So, how much of that world will be applicable to the crypto space? Like, are people in the crypto industry still looking at what is going on with electronic trading in stocks and thinking of ways to improve their own systems, or do you think there'll be a divergence because of just the legacies and that some of those lessons in TradFi may not apply?
I think there will be a divergence and an eventual sort of movement towards that. There is no national best bidder offer on crypto. There
Right.
needs to be probably eventually. It's 15 stages in the US, but in crypto, there's probably already 10 crypto exchanges in the US. And there's probably, I think we track over 50, 60 centralized venues, over 100 different exchanges overall, if you include decentralized exchanges. I don't think that number is going to stay around forever. It's getting bigger some weeks, but I think, 5, 10 years time, there will be a much smaller number of
Validate.
crypto exchanges. There will be consolidation, and it will be closer that you can do that sort of, I guess you can have a tape where you have a system information process or whatever it is, where you have sort of the price feeds from those exchanges feeding into a regulator that is able to say FINRA, whatever it is, and say, okay, here's what the prices are on these venues, and we can actually see things kind of clearly. We have a broad view of the market. That's where infrastructure players like Kaiko come in, and where we want to see the market move towards a more structured eventuality like that. I think where there are kind of best practices for all these things, and not where things are fragmented in time zones and countries in different regulatory regimes. There needs to be sort of, and that's one of the good things with Mika, and I guess what we're hoping with the US as well, is that there will be more regulatory harmony as well.
Mhm.
And it's kind of, usually it comes from the top down, I guess, in the US when there is a regulation. MiFID, MiCA, this stuff will probably feed across to the US, and there will be a version of that there that's quite similar, and you're seeing it across APAC as well. That will allow us to then say consolidate in a way where you can actually have a good view of the market, and you can do those things that you're seeing in traditional finance with electronic trading and things. But right now, it's it's called picking up pennies from a freight train for a reason in crypto. So we're not seeing as much of that because systems can break pretty easily.
Adam, from what do you think is more likely, a Reg NMS style equity solution to this, or could it end up being more for, let's say, reference pricing, more like what we used to have in LIBOR, where you just ended up with a group of, institutions that warehouse the assets, and they would then, in crypto, it could be done, I guess, every hour or every 10 minutes if you want it, or every second. But they would do a daily or an hour, afternoon fix. Everybody's comparing prices. Of course, then open to collusion, as we then learned, but at least to get going at story. So, which of those models do you think, or perhaps there's a third way, but when it comes to finding ways to establish that kind of unification of pricing or something at least closer, what are the avenues that are available?
Yeah, I think the LIBOR scandal is kind of like a good reminder for crypto of what it wants to kind of avoid. So like
Hmm.
I think we definitely do need the regulation. I'd say probably the former, but right now we do have daily fixings, but then you can have, if you're relying on 4 venues, 5 venues, there's issues like you can't have the liquidity is different, things change, it's trading 24/7. It's hard to price that off those so strictly as you might have in other markets. So I think it's going to be taking from both those cases, maybe more to the former, and building something that's fit for crypto, because you can't just have a one size fits all, but it will be leaning on what we see in traditional equities and commodities and other markets, because they've gone, there's lessons there in the LIBOR scandal and other things. But when will that happen? I'm not sure as well.
So I'm based in Hong Kong. I talk to a lot of people in Hong Kong, Singapore, Dubai, Abu Dhabi, and when I tell them, I wouldn't say anybody's like jumping up and down waiting for Mika to come in and regulate them. Um, so how you've referenced that several times. You're based in Paris, so that's the world that you inhabit. But of course you have a global business. So I'm curious about, do you see the a capacity for global regulators to kind of help smooth out some of these big differences, or do you think it's going to be quite difficult because some places will, the UAE, for example, might want to take a different regulatory path towards these issues?
Yeah, I think there's obviously going to always be sort of regulatory arbitrage, isn't there? Like you're going to have Abu Dhabi global market and places like that want to attract new firms. They want to attract, the biggest hedge funds in the world are all moving to the UAE. I guess they're all opening offices, so there's a reason for it. It's not just the kind of like lifestyle, but in the end of the day, the connectivity, the broad economy of like financial markets will remain in certain places. We've when Brexit happened nearly 10 years ago now, it was Frankfurt or Paris were going to be the new global hubs. Maybe Amsterdam for market making has kind of taken off, but London is still where you know every kind of facet of the office is there. They've got you've got investment banking, you've got markets, you've got trading, so it makes sense to be there if you're doing deals. Same with New York, same with Hong Kong and these places. I think it's very hard to change that kind of those like kind of market capitals. So those
Right.
will remain and those will feed down. So you will always have those regulatory arbitrages in other places. The BVI will always be a place you might set up a business and do something, the Caymans, whatever. But I think what matters is that we'll have that regulation in Paris, Frankfurt, as well as having it in London. And London will work inevitably with meek regulations, because the firms there will be interacting with firms and they'll have offices in Europe. And then in the US, that feeds down. Not to say it'll be one size fits all. It will be different in other places. We spent some time in Seoul a few weeks ago in Korea, and there's a much different conversations happening there, and it's
Mhm.
probably interesting because they've been, let's say, retail driven first on crypto, and it's just crypto exchanges. There's no kind of broader things. They've clamped down a bit, but now they're opening up to it and they're saying, okay, well, we want to look at stablecoins. That's a really interesting market, and we want to see what we can do at Korean one stablecoins, how that might work. And there's people having real conversations about that regulation in a different way. But they're also talking about ETFs, and they're also talking about how to legitimize the broader space. But it's just coming at it from a different angle. But in the end of the day, it's all going to get to the same place, I think. We had the ETFs they launched in Hong Kong right last May
Yes.
2024. Yeah, so they were actually approved before the US. They were approved December 2023, and they just didn't launch until another few months. So there's no, it's kind of, I think it's slowly going to be some harmony, but there will still be like differences and discrepancies in how things are done. There was in-kind transfers in some countries for Bitcoin ETFs before there were in other places. And there's other kind of idiosyncratic risks in certain areas that they want to avoid. So they won't fully take all of this. I mean, how you collateralize stablecoins might be different in Korea than what the Genius Act or what Mika is saying. Because, I don't know the size of the money market, the KRW money market funds are. Can you have a stable coin that's worth, the equivalent of a Tether there? Is there enough liquidity in the kind of in the money market funds to back that, or how would they be backed? So then there's going to potentially be different regulation on that, but with the same end goal of protecting those retail users, those people that are, in the end of the day, those are the people that were affected by the leverage washout. Those people with a couple $100 worth or a couple of thousand putting in a bit of money every now and then who kind of, check their account on Friday, October 10th, and it was down 80%. So, we want to get to a place where we might do different ways of getting there. There might be different tools to support stablecoins, make sure these things keep their peg. But in the end of the day, it's the same goal, I think. I think there's some clarity on that. Now, more broadly, I don't know what you think about it, but, 2-3 years ago, a lot of those regulators were saying, we don't want anyone to use it. But now I feel like there's more clarity around, well, they're going to use it. How do we make sure they use it in the right way? Is that sort of the conversations down there as well, or?
Yes, I'd say so. I mean, I think, I'm based in Hong Kong. The regulators here have been very proactive on these things. There's still gaps. One can nitpick at the decisions they made, but they've been very, much more progressive than other places. They're trying to be a leader. And Singapore, although it's gone a little quieter, has also been a leader in this space, but more from, I'd say, looking at crypto as a payments tool rather than a capital markets one. So I think that's really the big difference. Whereas Hong Kong, as you say, like London, like New York, it's it's an established, a real proper capital market.
Yeah.
Yeah. Look, Adam, somewhat grateful for you taking so much time to speak with me. Where can folks find your research?
Yeah, so they can find it on the kaiko.com website. They can log in there. We have a Kaiko app. You can get our weekly research. We do a report on a Monday called a data debrief. Every Wednesday we have a data point. It differs. This week it's on Coinbase because they got their earnings today. Might be on the Fed in a couple of weeks' time, looking at the impact of the market. So we do some kind of, think of it like a flash note and a weekly research on a Monday. There's some other tools coming out soon, a cool GPT model where you can kind of query Kaiko data through a sort of ChatGPT model. So that'll be cool. ChatGPT-esque model, but yeah. So as we check that out at kaiko.com. Thanks so much for having me.
All right, my pleasure. Adam Morgan McCarthy, research analyst at Kaiko. Thank you very much.
Thank you.